Good morning, everybody. Thanks for joining us for iFAST Corp's second quarter and first half 2021 results presentation. My name is Jean Paul from the Corporate Communications team. And together with me, we have Mr. David Young, who will be going through the financial results later on, and our Chairman and CEO, Mr. Lim Chung Chun, will be running through the business updates as well as the Q&A afterwards. So I will start with the key summary points. So our group's assets under administration, or AUA, continue to register new record levels. It reached 17.54 billion Sing dollars as at 30th of June. This is a growth rate of 57.3% year-on-year and 21.4% year-to-date. The AUA of unit trusts, a key investment asset class, in fact the largest investment asset class contributor to our AUA, that grew to a record 12.87 billion Sing dollars, which is a growth rate of 48.7% year-on-year and 18% year-to-date. As a result of the increasing AUA, our group's recurring net revenue has continued to grow at a robust pace. It increased 39.2% year-on-year in second quarter and 34.3% year-on-year in the first half of 2021. The growth in non-recurring net revenue has moderated in second quarter, increasing by 15.3% year-on-year in second Q 2021, compared to a more robust growth rate of 59.8% year-on-year for the first half of 2021 as a whole. Trading activities were generally more subdued in second quarter of this year compared to first quarter of this year, given that the general financial market conditions were more cautious during the period. The net inflows of client assets remained very healthy at 0.84 billion Sing dollars in second quarter 2021, which leads to total net inflows of 2.12 billion Sing dollars for the whole of the first half of this year. Net profit grew 55% year-on-year to 7.02 million Sing dollars in second quarter 2021. For first half, net profit grew 94% year-on-year to 15.84 million Sing dollars. Reflecting the positive operating leverage of our business model, the PBT margin has continued to increase to 34.2% for first half 2021 compared to 29.6% for the whole of last year. iFAST Corp believes that the robust growth that we have seen in recent times is a result from hard investment that we have made to build up the strong integrated digital wealth management platform. We will continue to work hard on the various initiatives in all our existing markets that we operate in to ensure that our medium to long-term growth prospects remain strong. Barring unforeseen circumstances, we expect business performance for full year 2021 to show healthy growth compared to last year. In addition, we expect to increase our dividend per share in 2021 compared to last year. For the second interim dividend for second quarter 2021, the directors expect a dividend of 1.1 cent per ordinary share, which is an increase of 46.7% year-on-year compared to the second interim dividend payout for second quarter of last year, which was at 0.75 cents per ordinary share. A couple more points on the key summary. So as announced by the group on 30th of June this year, we have led a consortium in the submission of an application for a digital bank license in Malaysia. This continues our efforts in seeking to tap into global digital banking and fintech opportunities that we see. And in Hong Kong, discussions with the industry players have been ongoing as part of our preparatory work for the eMPF project. By the end of this year, the group targets to be able to give some guidance on the potential growth of its overall Hong Kong business for 2023/2024 and beyond. Looking at our AUA chart, so that's grown to a record high level of 17.54 billion Sing dollars as of 30th of June 2021. This represents a year-on-year growth rate of 57.3% as announced just now, and 21.4% year-to-date. So we show the split between B2B and B2C. So the majority contributed by B2B at roughly about 68%, and the remaining 32% from the B2C business divisions. On this slide, we've been showing the net inflows numbers. So second quarter of this year, we saw net inflows of 0.84 billion Sing dollars. For the full first half, the total net inflows are at 2.12 billion dollars, significantly higher than the first half of last year. And looking at the gross UT subscriptions, a very similar trend where we see second quarter net inflows for UT, or the gross UT subscription inflows rather, That's pretty strong as well in second quarter at $1.76 billion, and the full half of this year we're at $3.97 billion. And I will now invite our CFO, David, to run through section 1, which is the financial results. David.
Good morning, ladies and gentlemen. I am now presenting the financial result for the group for the second quarter 2021 versus second quarter 2020. Our gross revenue increased by 31.7% to 50.8 million. Our net revenue increased by 32% to about 26.2 million, mainly due to the growth of our AUA and also the increase in the stock and ETF processing fee and forex margin income. Our other income dropped by about 73% to about 0.49 million. This was mainly due to the decrease in the receipt of the government grant in this year compared with last year. Our operating expenses increased close to 15% to about 18.25 million, and our PBT increased by 46.3% to about 8.4 million. PAT, a 55.5% increase to close to 7 million, and our net profit attributed to owners of the company for the second quarter of this year increased by 55% to 7.02 million. EPS for second quarter 2021 is 2.54 cents, represent a 52.1% growth, and the dividend per share is 1.1 cents, represent a 46.7% growth. Next is the comparison of the first half financial result for 2021 versus 2020. Our gross revenue for the first half of this year achieved a close to 38% growth to about 106.12 billion. Net revenue increased by 41% growth to about 54.68 million. Other income, as mentioned earlier, due to the decrease in the receipt of the government grant, there's a drop of 39%, about 1.44 million. Operating expenses increased by 20.6% to 37.3 million, and we record a smaller finance income, only about 50,000, mainly due to the decrease in the bank interest rate since last year. We record a small share of result loss associated about 80,000, and our PBT for the first half of 2021 it achieved a close to 85% growth to about 18.7 million. Our PAT increased by 95% growth to about 15.7 million. Net profit attributed to owners of the company for the first half of 2021 achieved a 94% growth to about 15.84 million. EPS for the first half of 2021 is about 5.76 cents, represent a close to 9% growth. Dividend per share for the first half of this year is 2.1 cents. It's 40% growth compared with first half 2020. So this table shows the financial result for 2017 to 2020 at the first half of 2021. This chart shows the PBT margin for the group based on net revenue. Our PBT margin for the group for the first half of 2021 achieved about 34.2%. Return on equity represents the net profit divided by the average shareholders' equity during the year. For the first half of 2021, we achieved a 28% of return on equity. Some financial indicator, our EBITDA is 23.1 million. Our net cash position is about 60.91 million. And our operating cash flow for the first half of this year is 23.94 million. Capital expenditure for the first half, we spent about 5.3 million. Our net current asset is 72.07 million, and our shareholders' equity is 119 million for the first half of 2021. This is the further breakdown of our net cash position. So our cash and cash equivalent is about 41.59 million. Other investment, including investment in financial assets that are under the current assets, about 19.3 million. So total cash and other investment is 16.91 million, and we are in a net cash position. This chart shows the group operating cash flow from 2017 to 2020 at first half of 2021. Our group operating cash flow for the first half of 2021 is about 23.94 million. Capital expenditure, the spending for the first half of 2021 is 5.31 million. Our number of issued shares at the end of June 2021 is about 236.5 million. So this is our consolidated financial position as the end of June. So as the end of June 2021, our total non-current asset is about 57.4 million, and our total current asset is about 210.4 million. So total asset as at end of June 2021 is about 267.8 million. Our share of equity, as mentioned earlier, is 119 million. Excluding the non-controlling interest, is about 118.2 million. Our total non-current liability is about 11.2 million, while the total current liability is about 138.3 million. So our total liability is 149.58 million. So total equities and liability is 267.8 million. And our current trust account as at end of June is about 983 million. So lastly will be some info about the second interim dividend for financial year 2021. Our dividend per share 1.1 cents per share. Ex-dividend date of August 2021. Record date and time at 5 p.m. for 4th August 2021, and the payment date is 17th of August 2021. As mentioned earlier, our second interim dividend is 1.1 cent, that represents increase of 46.7% growth compared with second quarter 2022, which is 0.75 cents per ordinary shares. That's all from me. Thank you.
Hi everyone. Now I'd like to move on to the next section. We'll talk about the performance trend. So this slide here, we see the breakdown in terms of the AUA. First chart will be in terms of the market. Second chart will be in terms of the product category. So as you can see, Singapore continues to be a key contributor to the overall market. Singapore currently contributes 69.5% of the overall AUA. In terms of the products, unit trust continues to be our key product category, contributing 73% of the overall AUA for us. And ETF basically accounted for about 16.5%, and then cash and bonds contributing the rest. This chart we've been showing every quarter. Essentially, it shows that over the years, the net revenue for the group has continued to grow. We have categorized net revenue into two components. One's recurring, the other one is non-recurring. As you can see, non-recurring that can tend to be a bit more volatile. This particular chart shows the ratio of the net revenue as compared to the AUA. As you are aware, we have the AUA as a key KPI for ourselves. We generally aim to continue to grow the AUA. I think we have also stated previously that we have a target of 100 million AUA by 2028. We remain committed to that group. So this particular chart then shows all the AUA on average, what kind of net revenue are we actually receiving. So in the first half of this year, we saw that net revenue as a proportion of AUA was about 69 basis points. It's lower than what it was last year, and I think the main reason is because certain new asset class, particularly stocks and ETF, that doesn't affect direct net revenue. So because of that, you find that it doesn't attract a recurring net income, right? So because of that, recurring net revenue as a proportion of AUA has been lower than it was last year, because the stocks and ETF categories are actually growing faster. But I think what's important from our perspective is that overall net revenue continues to grow at a robust pace, including the recurring net revenue. We'll look at some of the numbers further in the subsequent slides. So this particular slide shows the recurring and net recurring net revenue number. As you can see, in the first half of this year, we continue to see quite good growth in terms of the overall net revenue. Recurring net revenue grew 34% in the first half of this year. If I take the number for the second quarter, it was actually about 39%. Non-recurring income, which depends more on the actual level of transactions, for the first half it grew almost 60%. But if I look at the quarterly breakdown, the second quarter, the growth was slower. The growth was only about 15% year on year. But because first Q was very strong, the first half growth was almost 60%. So this particular set of number will tend to fluctuate more, the non-recurring net revenue. And the main reason is because financial market conditions tend to change along the way. Sometimes the market can be very bullish, sometimes the market going through corrections, sometimes bear market. So the non-recurring net revenue tend to be more volatile. But importantly, we continue to be able to grow our AUA as a group, and as a result of that, we have been able to continue to grow our recurring net revenue as well. So this slide shows the breakdown in net revenue for the different markets. As you can see, Singapore continued to be very strong. It grew 46% year on year for the first half, and that drive a growth of 41% overall for the group. These are the numbers of the breakdown for the B2B business, and then next slide for the B2C business. I'll leave it to you to look through in more detail. In terms of P&L, we essentially have a growth of 94% in terms of the net profit for the group in the first half. Profit before tax grew 84%. And as you can see, the various key markets saw improved profitability as well. Singapore, Hong Kong, and Malaysia also improved profitability. The losses from China was a bit higher. But I think, as I have mentioned in previous quarter, we feel that China is at the point where we would like to ensure that overall growth for China business will continue. We think that that will be the right strategy for us in years ahead, because I think the potential for China is huge. Okay, yeah. I would just like to give a bit of update on some of the new initiative that actually the group had. I think earlier on in the year, on 30th January, we announced that we have participated in a successful tender for eMPF platform project with PCCW Solutions as a prime subcontractor for the category C of the work, which includes MPF scheme operation services, transformation services, and user delivery services. Recall that back then, MPFA announced that they have appointed PCCW. I think recently we had a query from SGX about a movement in share price, and we responded by saying that we feel that part of the reason for the share price increase in recent times could be the fact that we have actually been having regular discussions with the industry in Hong Kong regarding this particular project with a view to finalize the key contractual terms of the work that we actually will be undertaking. We hope to be able to finalize that. At this point in time, we're not able to announce too much further detail, but we hope to be able to give some guidance, the potential growth of our overall Hong Kong business for 2023/24 and beyond. There's also the recent announcement that we've made, whereby we announced that we have led a consortium in the submission of an application for digital bank license in Malaysia. We believe that we have formed a strong consortium to apply for the license. We have several partners, and we expect to have a 40% stake in the digital bank if we are successful, and the consortium comprises both local and foreign shareholder, but the Malaysian shareholding will be the majority. The application that we have put in for Malaysia continues our overall pursuit of a digital banking license. We believe that the fintech industry globally is still in the early stages of transforming, because I think that fintech has a long way more to go. Fintech have actually not gone as global as what it eventually will be, and being able to have a digital banking license will actually help us to better realize some potential that we foresee in the fintech industry. The subsequent slides give some further detail on the individual markets. I'll not go through the detail. I'll leave it to investors to get the details of the individual market. With that, we'll start the formal presentation here, and we'll be happy to take the questions that you may have.
So all attendees, you can actually hi everyone. So now we are in for our Q&A session. So what you can do is actually you can use the raise hand function or type your questions in the Q&A function box to let us know the questions that you may have. And for those who have raised your hand, then we'll read out your name before allowing you to talk. So we have our very first question from Akash from UBS. So Akash, you may unmute yourself to ask a question.
Hi, great. Thank you for the presentation. Can you hear me all right?
Yes.
Okay, great. My first question, I'm referring to the non-recurring margin decline in general, and more specifically on the B2C side. So I think the decline in this non-recurring margin on the B2C side, as you've said, it was largely due to financial market conditions. I think it does seem a little bit more excessive, even if we take into account the trading activity decline that happened Q1Q. So I'm just wondering if there is some sort of seasoning of the AUA issue here at play as well. So, for example, the AUA that you had prior to FY20 still is generating, 90 basis point revenues that you used to see. And then the AUA that you've gotten in the last 12, 18 months is probably not seasoned enough to be able to generate that kind of income. Is that sort of a fair assessment? How do you think about these things? If you could give some color on that, that'd be very useful. That's the first question. The second one is just on China. I think the growth seems to have slowed down in terms of AUA. So is that sort of the new normal, or do you think it probably can pick back up again in the coming quarters? And then the third question is on OPEX. I mean, I think compared to your guidance, it does look like that, the OPEX was quite low this quarter. It surprised. How should we think about it for the rest of the year? Those are the three questions from me. Thank you.
Okay. Yeah, so as far as net revenue is concerned for the non-recurring item, that is actually an item that tends to be more volatile. So for the non-recurring net revenue, there are a few main components. The biggest component will be the transaction commission from both stocks and unit trusts. The other component will be actually the forex that we actually earn. The first component in terms of the commissions for stocks transactions and unit trust transaction, that item tends to be somewhat volatile depending on the market condition. So if you look at the overall situation, you should find that first quarter is actually the period whereby trading income generally in around the world actually tend to be it was actually hitting a high. Second quarter, the general trading activity, both of stocks as well as unit trusts, actually saw some decline. I believe that that is a trend that you probably see as you see more financial institutions announcing their results for the second quarter. I think we've seen that some banks have reported some trading income that tend to be lower than the first quarter of this year, and we are accordingly see the similar trend. I don't think there's any particular seasonal factor in terms of calendar year effect. I would say that it was largely a result of the overall financial market condition. I think first Q, the market was going up in a big way. Second Q, we saw the effect of the correction in a number of different markets, particularly in China. So actually that affected the overall volume for both stocks and unit trusts. I think the US market may be hitting a record high, but if you look at some of the more speculative counter that has sort of eased off in second quarter compared to first quarter. So basically we were coming from a situation where first Q was stronger than what you normally would expect, and then second Q you saw the correction from the high level. That I would say would be the way you're looking at it. As far as the forex margin is concerned, that was also down because that is also somewhat correlated to the amount of transaction that we have each quarter, because as investors buy into the US or Hong Kong stocks, or they buy into the unit trust in different currency, then there's some forex conversion that we actually do on behalf of investors. So when the level of transactions go down, that actually gets affected as well. We see this as a set of numbers that will, in a sense, be bouncing around. We don't see that as something that is a structural trend. We see that as largely a financial market effect. So that's first part of the question. Second part regarding China in terms of growth rate, I would say that there's some of that effect happening as well, because China actually saw a substantial decline or substantial correction that during the second quarter that actually have a tendency historically to affect the overall volume that we see in the short term. So year on year we're still growing very strongly, but quarter on quarter the growth rate can be significantly affected by some of this short-term market fluctuation. I think importantly, as I was mentioning, the key number for us is the overall AUA. I think that continues to grow at a very healthy pace. The net sales for us at 840 million for second quarter continues to be very healthy as well. And so we see some of this weakness as more of a shorter term kind of a situation that is dependent on short-term market conditions. The next part of the question relates to operating expense. You're mentioning that is a bit lower. I would say that on average, on a year-on-year basis, there's some growth in operating expense because we continue to grow our overall efforts in enhancing our overall services as a group. On a quarterly basis, there can be some moderation in the operating expense when the net revenue number as a whole ease off, because there's some perhaps a component in the net revenue number that is dependent on that sort of performance base. So when the net revenue number tends to be lower, then some of the variable components such as performance-based incentive and bonus and so on will be a bit lower. And I would say that it's probably the key reason why operating expense was lower.
Great. Thank you very much for that. If I can just follow up on the first question, right, regarding the margins. So I'm just going to refer to some numbers here, right? So if I look at the non-recurring, if I look at the B2C net revenue to AUA, so that's B2C margins, right? So they were in the range of 90 to 95 basis points last year, every quarter. Then in Q1 this year, they jumped up to like 1% because the trading activity was obviously, it was a very active quarter. This quarter, this number fell down to like 70 basis points. So even if what I'm saying is if I take into account this decline in trading activity, we've probably gone back to like a Q3 level of last year. Why is this number not 90 basis points? Why is this number 70 basis points? So is there something one-off this quarter which will sort of, change next quarter, or should this 70 basis point kind of be the number that we keep in mind for the rest of the quarter?
You're referring to the non-recurring net revenue margin for second Q for second Q number, right? In terms of that's what you're referring to.
Second quarter number, and I'm actually referring to B2C total, I'm looking at the B2C margins overall. So B2C revenue divided by AUA. What I'm saying is it used to be 1995 last year every quarter. Then it went up to 1% first quarter this year because of, pretty hot markets. And then it's come down to 70 basis points now, which is the reason I say that, just trading activity seems to be hard to explain all of it.
Okay, I would say that in terms of net revenue as a whole, probably two main effects. One is a decline in trading activity, and I think for B2C particularly, that accounts for, I think, a bigger part of the stockbroking activities actually comes from the B2C side of the business. And as a result of that, the B2C then tend to see a bigger decline when the stockbroking side is out during the quarter. That's one consideration. The other consideration would actually be, if you're talking about the recurring part as well, the lower interest rate. I think interest rate have actually seen a decline globally. And as a result of that, we actually find that the net interest income from client assets that we are able to derive have also seen some reduction. And that has been a trend that we saw in the last couple of quarters. And I suppose probably in second Q, we saw a bigger impact coming from that. So I suppose the combined effect of the two parts probably contributed to a bigger reduction for the B2C side.
Okay, got it. Thank you for that. That's all for me.
Thank you, Ashish. So we have some text questions. So the first one is from Royston. So Royston, I'd like to ask two questions. The first one is regarding the acquisition of the fund management business from DWS, which was announced in April. How will iFAST benefit from this acquisition? Higher fees from co-branding these new funds, or having a larger stake of funds to offer to clients?
Yeah, so for this particular acquisition, I would say that the main intention isn't really higher margin, even though we expect that there will be a positive revenue effect for us overall. We are actually taking a broader look at the overall industry. So I think for people who understand the fund management industry quite well, we actually find that in the unit trust business, you have the fund manager who manage the funds, and then you have the distributors. The fund managers who manage the fund, who create a fund, there's actually, in a sense, two parts of their work. One part really is the actual investment management, decision making, what stocks to buy, and so on. That is something that most fund managers set up to do. But in order to do this first part of the work, the investment management, the fund managers actually have to do quite a bit of other work related to administration, compliance, and the ongoing, perhaps IT related work, just to be able to manage a fund. So if you look at what happens in Singapore, actually there aren't that many local fund managers who are able to have a retail fund management license, a retail unit trust license. You have the bank-backed fund fund manager. We have quite a long list of local, whether you call it boutique fund manager or otherwise, but among the local boutique fund manager, you actually find that most of them have a restricted license that allow them to distribute funds to accredited investors, but not to retail investors. We look at the industry, we know that this is actually an underdeveloped segment of the overall industry. It is a situation whereby you may have very good fund managers among many of these local boutique fund management firms, but they're held back from being able to distribute retail funds because of the fact that distribution is extremely distribution of retail funds, creation and maintaining retail funds is actually a very expensive exercise. Expensive not just in terms of having to do the stock picking, but expensive in terms of all the administration and the compliance work that actually needs to be done. So we look at the industry and we feel that as a distributor, as a platform, there is room for us to look at how to combine the fact that we are a platform that is already doing the IT administration work on behalf of the distributor. How can we combine that with the fund management side of the business to create a business model that will allow the whole process to be a lot more efficient? So that is really the starting point in terms of how we look at this. So if you look at this particular acquisition of the DWS funds that we are making, you notice that we're buying over the unit trust part of business, but we're actually still delegating the management of the fund back to DWS. So the actual investment management decision doesn't change, but we actually take over the legal ownership of the fund. We take over the legal management of the fund. We take over the administration of the fund. So that is something that we believe can help us strengthen our overall capability as a platform that actually try to serve investors as efficiently as possible. So in other words, we are looking beyond just being able to have our own iFAST branded fund, because we are already carrying thousands of funds. What we truly want to do is to be able to play a bigger role in deriving extra efficiency from the overall business model that will help investors and that will help the fund managers and partners themselves. That will then along the way have a lot of synergistic benefit to us and the platform. So we're coming from that perspective when we look at this particular application. I know that it's not easy to understand offhand, but hopefully over time we can explain more in terms of how that truly works, how that enhances the overall business model.
So the second question from Arthur is, could you explain the new revenue streams from the US stockbroking service in the India market? How will this work and how much will iFAST benefit from it?
Yeah, so if you look at our business for, let's say, whether it's Singapore or Hong Kong and coming up Malaysia, you actually find that in addition to having access to local market, local stock market, we also link up the access to the US market and Hong Kong and China market and so on. I think the way investors invest are changing quite rapidly. Investors are no longer just investing in the market that they are essentially present in. So Singapore investors are increasingly investing outside of Singapore. They're buying not just Singapore stocks, they're also buying US stocks and Hong Kong stocks, and in the future, I think increasingly Chinese stocks. And for that reason, if you look at how we have our stockbroking business, a large part of the business actually comes from US dollar. So we are looking at basically doing a similar thing for our India business, which currently is only linked up on the low stock exchanges. So there is demand from our investors and advisors in India to actually have a linkage to the US market. That is really the key intention.
The next question is from Uma. She has 2 questions. So the first one is, how much of a dividend increase can shareholders expect for FY 2021 compared to FY 2020? And beyond FY 2021, will iFAST continue to give out more dividends to shareholders? The second question is, as iFAST key markets have different impacts from the virus, which market is the group looking at for a boost for the second half of 2021, and which market will be a little more challenging?
On the first question, how much of a dividend increase? I think for the second quarter, the increase was about 47% year on year. We haven't actually guided the actual number for the year as a whole, but I would say we hope to be able to give a similar percentage increase as the second quarter. Hope that for the full year we can give a similar percentage increase as the first second quarter. Of course, in the end, it depends on the actual results. Second question, iFAST have a different impact from the virus. We don't really give the exact guidance for the short term on that basis. To be honest, quite difficult to be able to predict the very short term performance on the basis of one. So I think we probably can't be too precise on this calculation.
Maybe I'll interrupt with a question that's asked via the raise hand function. So Yong Hong has a question for us. Yong Hong, you may unmute yourself to ask your question.
Hi. Hi, can you hear me? Sorry.
Yes, we can hear.
Hi, thanks for the presentation. So just a couple of questions. So maybe again, in terms of the net revenue over AUA, could we expect the stocks and ETF to continue growing from the current 17% level of as a percentage of the total AUA, especially with the launch of these China Asia services? So any color and guidance on this would be helpful. So secondly, in terms of the recurring revenue over AUA, it does seem to be trending lower as well to the 46 basis point level. Is this also due to the lower interest rate environment, or is there any change to the fee structure? And the third question will be, in the medium to long term, as you scale your AUA, what kind of overall net revenue over AUA levels are you expecting? And could we expect to revert back to the 80-20 split between the recurring and non-recurring revenue? And the last question will be, so in terms of your disclosure on the customer account and the number of wealth advisor, could I clarify if these are the active users? These are my questions. Thank you.
Okay. On the first question, the proportion that's contributed by stock and ETF to the AUA, I would say that we do expect that the proportion contributed by this will increase as a proportion of overall AUA, because that particular segment is growing at a faster pace than it's growing at a faster pace than what we are seeing from some of the other asset classes. So we expect this proportion to increase. However, I also like to add that in the end, what really is important for us is that even as this proportion increase, then the overall AUA for us from the other asset classes, particularly unit trust, can continue to improve. And that in fact has been the benefit that we have actually seen. So we have seen in the last 2 years, 3 years that even as the growth from stocks and ETF have been very strong, we actually find that that actually has had the effect of improving the overall growth rate, also on the unit trust as well. That I think is the important point, because I think for many financial institutions, typically they don't want to embrace people who are into unit trust, for instance. They don't really want to embrace ETF, for instance, because they feel that that asset class have lower margin and that may negatively impact their overall business. For iFAST, we take the view that ETF is as a class that's here to stay. In fact, as a proportion of overall global market share in the respective market within that should increase. So the right thing to do really is to embrace this particular. But even as we do, the key thing is, are we also able to grow the volume that we're seeing from the unit trust? And our experience in the last 2 3 years has been that yes, it has been able to have us grow even faster. I think that is actually the key. Yeah. So the short answer is yes, we expect the proportion to increase further from where we are, but at the same time, we still expect that unit trust is to be able to grow and will be important. Second question I think was regarding the recurring margin. Yeah. So if you look at a recurring net revenue margin as a proportion of AUA, that has seen some decline. So again, it's mainly 2 factors. One is the fact that it's a bigger proportion of stock and ETF. And secondly, there is in the past 1 year some negative impact from the much lower interest rate environment. So the two actually sort of add up. Yeah, that's actually been the reason to explain the third part of the question is regarding the account that we. Can you repeat the question again? The part of the account.
Yeah, sorry. So in terms of the customer account and the number of wealth advisors that you disclosed in your presentation, could I just clarify if these are the active users? I think these in the last few slides. I think in your ecosystem, the 620,000 customer.
What number of users on our B2B?
Yeah, are these actually reflect the number of active users?
It depends on the term. Maybe active.
I think this approved account. Some of them could have. Some of them could be non-active in the sense that there's no coding. Yeah, so it includes account without coding as well. But as a financial institution, we have to do regular review for inactive account. So if the account continue to be inactive for a long time, then we'll actually tend to have to suspend those accounts. But essentially, yeah, the short answer is it does include account that does not have any coding.
Okay, got it. Thanks. I think I had also a question in the medium to long term. So as you scale your AUA, what kind of platform margins can we expect in terms of net revenue over AUA? And also, could we revert back to the 80-20 split between the recurring and non-recurring revenue post the pandemic in the medium to long term?
Yeah, we have not given any actual guidance on how the revenue might be in the long term. But at the back of my mind, if I were to think in terms of what could happen in the next 10 years, for instance, if we move towards having that 100 billion AUA type number, I would expect that there will be some reduction in the margin. If it's something along the line of say 60 basis points, if there was 70 basis point, then I would say that that is probably something that doesn't sound too unreasonable. That's how I can say. Yeah, we haven't had an exact guidance or forecast, but offhand, yeah, if 60 basis point, I think it is unreasonable.
Okay, got it. Yep, thanks for that. Thank you. That's all I have.
And we have another question from Jia Wei. Jia Wei, you may unmute yourself to ask the question. Hi Jia Wei, are you there? You may unmute yourself to ask your question.
Still muted.
Like Jia Wei is not there,
Yeah,
so
maybe
we'll
we'll
proceed
take
to
some,
our
yeah.
text question. So we have another question from Royston. So this is he said that there's this news that Tiger Broker has moved into offering unit trust. Does iFAST see the company as a credible competitor, and does this move cause any concern?
I believe they've been doing unit trust since last year. Yeah, certain things I'm not at full liberty to disclose, but I would say that in today's environment and especially for a business model, a company can be both a competitor as well as a client. Yeah, so that should be the way to actually look at it. So it can actually be both a additional competition as well as additional revenue from some of these financial institutions that are actually out there. That should be the way to look at our overall business. So I would say that we are not concerned as a whole.
The next question from Gerald. So he's asking whether we can provide some colors with regards to the announcement on Friday, on 23rd July, on the iFAST Securities US Corporation. Is iFAST entering the US market? Will it have any material impact to the financial after 31st December this year?
Yeah, for this particular announcement, we have incorporated a company. The intention is essentially that we intend to have a direct linkage to the US exchange. We incorporate a company. We intend to put in an application for trading membership on the US exchange so that we can link up the exchange directly. The same way as we've done for Singapore and Hong Kong market, we intend to do so for the US market because US is actually today our key, I think it become a key segment of the stock broking part of the business. And it is the biggest market in the world. It will continue to be a key market, and as part of our overall business model, whether B2B or B2C, having a direct linkage in the long run, I believe will give us the advantage. So it's really from that perspective. Will it have any material impact to the financial after December 2021? So for this year, no impact. For next year, I would say no substantial impact as well. Beyond that, we think that we have to improve our overall business for this segment beyond 2021. But in terms of actual impact in the short term, we don't expect that.
We have a few questions from Andrea. So it's on the DWS agreement. Is the 600 million AUM included in the latest AUA balance of 17.5 billion? The second question is, does iFAST expect more AUM to come from DWS under this arrangement? And her third question is, would you share some colors on the margin iFAST received under the arrangement compared to your conventional unit trust AUA?
Yeah. So on the first question, the 600 mil AUA, is that included? The answer is no. The completion is expected to be at the end of July. So that should add the AUM, not the full 600 mil, because there's some overlap. Because some of the 600 mil is actually distributed by iFAST as well. So in terms of the addition to the AUA for us, we stay probably closer to 400 mil plus. That should be a number to think about. iFAST expect more AUM to come from DWS, not from DWS, or not in terms of the further acquisition from DWS. It is possible that we have further collaboration with DWS going forward, but not. In response to the second question is, yeah, not in terms of actual. We share some color on the margins. I would say that for the margin, the margin that we will have. So as I mentioned, there's two parts to it. One part is the AUM that is not on our platform yet. Then the other part is the AUM that is already on platform. So the AUM that's already on the platform will not increase our AUA, but you bring about some additional revenue. So you add on to the margin for our existing AUA. For the part that is not on our platform yet, there will be the revenue margin. I would say that because we also outsource it back to DWS, the margin that we get will be less than our average AUA margin. As a platform.
The next question from Benjamin. Is it possible to quantify the net revenue impact from the decline in lower flat transaction processing fee of 880 to all B2C clients in Singapore operations on dealing of security listed on Singapore Exchange from April 2021? And net revenue versus AUA margin declined 13 bps Q on Q to 0.62%, which was impacted by an 11 bps Q on Q decline in non-recurring net revenue versus AUA margins. What could the long-term net revenue / AUA margins be? Do you think that margins could hover around 0.6 to 0.7% in the next few quarters? What are your views on working with strategic partners in the various key markets, especially China, to hasten the path to profitability?
So first part of the question, I would say that the actual impact on us arising from 880 is not significant, right? In terms of the overall impact on the net revenue for us. There's some reduction, but it's actually considered relatively small. Second part of the question, the decline in margin. Yeah, so yeah, we don't like to give the guidance in terms of next few quarters because we are also not able to predict the exact transaction volume. But I think earlier I was mentioning that if I think in terms of the longer term, and if I think in terms of margin of 60 basis points in the much longer term, 10 years or so, I think that doesn't sound unreasonable. It's not exactly a guidance, but it doesn't sound unreasonable. Third part, yeah, in terms of working with a very strategic partner, I would say that as part of our overall B2B business model, we are always looking at linking up with various strategic partners. I think that is core to the overall B2B business. Strategic does not mean equity partnership. Of course, sometimes we do explore some equity partnership, and we don't rule out the possibility of that. But I think the key really is that that probably isn't the most important thing for us, because the key about B2B business is the ability to work with various partners. So if it's equity partnership, you tend to be able to work with only limited number of equity partners. But if it's on the basis of service levels and mutual benefit in terms of the partnership, then there are many partners that we can actually work with, and that is the essence of our B2B business. And that is a list that actually continues to grow, has been growing, and will continue to grow further.
Another question from Andrea. Just to touch on what you mentioned earlier on the market fluctuation which affected non-recurring revenue, do you think you could provide the split of transaction fees and FX fees for the non-recurring revenue for first half 2021 to compare against figure provided in the annual report, and a gauge of the level of margin from these transactions fee / commission versus CT?
Yeah, we'll look into being able to provide more breakdown going forward, especially whether it's annually or halfway annually. We will look into that. Thanks for the consideration.
Next, from Uma, at $9 per share now, is management confident that the stock can keep going at this pace, or will this slow gradually?
We don't actually give any forecast for share price. Certainly, we are not supposed to. But as someone who is actually investor at heart, what I would like to say, share would be just some of my observation in terms of what's happening in global stock markets in recent time. I think I was an analyst myself, right, in 1991 to 1998. I have always been an investor, and I classify myself as a value investor, look for value and so on. Because of that, I typically do play a lot of importance on metrics like PE ratios and so on. I understand that iFAST at this point, if I look at current year, next year, the PE seems very high. But my take about what's happening globally really is that business models are actually with the emergence of internet, I think business models are changing very fast, very rapidly. In the last 20 years, in recent times, I think it expedited for them in terms of the change, and I would say that in the next 5 years, 10 years, we continue to shift. And as a result of that, we actually start to see the big differences in terms of valuation from one category, between one category company and the other category. So the category that benefited will be the internet-related business. These are commanding a huge valuation. On the other side, you actually have companies that command very low valuation even by traditional metrics. I think that's what's happening today, and in a sense, investors are gradually, increasingly recognizing the fact that things are changing in a major structural way. So if I take specifically the fintech sector, more and more I've been having the feeling that we are actually still in the early stages of the changes in terms of the way the business environment is changing. I would perhaps say that some of our present shareholders are recognizing that potential for iFAST to be one of those companies that are able to embrace this major change and to actually benefit from this major change that's happening and will continue to happen perhaps at an accelerated pace in the next 5 years, 10 years. And I think that is really perhaps the difference that we're starting to see. I mentioned a number of times in the past year or two that we believe that the fintech sector a long way more to go in terms of the changes. And when I say that, I'm also making reference to the fact that internet businesses in other industries you're seeing a lot of global businesses. I gave the example of Netflix, Spotify, and so these are global businesses. They're based in one country, and you're able to get customers from all around the world. And if you think about it, you actually find that in the financial sector, that hasn't happened in a big way. In fact, we're in the early stages of some of these things happening. The power of the internet is the ability to cross-border. Well, the ability to reach out to everybody in the same country, but I think at the same time also the ability to cross-border. Of course, in the financial sector, it doesn't happen in a big way because financial sector is much more highly regulated than other industry. And because of that, you actually find that the traditional financial institutions have not been able to run a global business model, a truly global business model in any meaningful way. My take is that if you have a fintech company that's able to have a business model that truly take advantage of the strength of the internet and be able to grow even more because of the open nature of the internet, then I think the potential growth rate that we're looking at should be different from the way things are looked at historically. Historically, when we look at a particular financial sector, we think in terms of the growth of that financial sector in that country. So if you come from a small country like Singapore, then it looks like, hey, your potential is very limited. But if you think of it as a new world that is emerging whereby you can be based in just a few countries and you can increasingly tap into an increasing customer base from all around the world. And perhaps iFAST is really at the startup phase from a perspective of being able to run a global business. So I would say that perhaps some investors are recognizing some of that potential increasingly. And as a result of that, I think we're seeing some of the valuation being built in, the more premium valuation being built into iFAST. That's my take in terms of what's happening. I think the other part that I'd like to mention really is, in terms of valuation, I suppose historically we tend to think in terms of the valuation this year and next year. But perhaps, we should start to think in terms of valuation, not just this year, next year, but next 5 years. And there are times whereby certain things happen that will allow us to be able to make a potential more significant jump in terms of overall revenue. So for instance, something like EFBF, if we eventually finalize that, then that can be something that will very significant impact, not so much this year, next year, but perhaps 3 years down the line and beyond. So these are some of the factors to consider, I would say, for iFAST in terms of looking at the valuation. So that is what I can say at this point, without trying to predict what the actual share price will be.
The next one is not a question, it's a comment from a shareholder. So he's saying, I do appreciate the management for all the hard work, and I urge shareholders do not look at short-term fluctuations, but look at their overall growth. Thank you, Yong-Sing.
Thank you for the comment, and in a sense a bit related to the comment that I've just made. I think, if you look at the quarterly results, there are some of this fluctuation. I do note some of the comment in the forum as well. There's some concerns about the fact that second Q number is significantly lower than first Q number. I personally see this as some of the fluctuation that we sometimes see on a quarterly basis. What is key to me is that the overall long-term growth that we're trying to build, that doesn't get diminished. That is the way I actually look at the situation. So if we just think in terms of how things are going to change in not just 1 year or 2 years, but actually the next 5 years, that itself, I think will bring about a very different perspective in terms of how to look at that valuation.
I have a question from Alan regarding the fund of funds in China. He's asking whether there's any updates.
We have launched our fund of funds in China. So that is actually meant more for the creditor investor equivalent in China. We've launched that. We are gradually increasing the AUA, but still a small number as of now. That's something that we generally expect. Is like when we launch our DPMS in Singapore, Hong Kong, Malaysia. That is something that we will gradually build up in terms of AUM over time. Short term may look very small, but over time you add up and become important. More importantly is the fact that we look at this service not just as a fund management service on its own, but as an overall addition to our overall platform service to make us more competitive platform.
Next question is from Kelvin. He's asking what type of unit trust does iFAST intend to launch after buying GWS?
Perhaps I'll talk about two main areas. One area is it could be still in a category of equity or balance fund type of. But I'd like to stress that when we are looking at this, we're really looking at it not so much as launching something, a product of our own to replace what all the various fund managers already have today. We don't think that we can, on our own as a fund manager, do better than all the fund managers collectively that we're looking at. So that is not the true intention. But as a platform that work with various partners, we do have various partners or B2B partners who are using our platform that are actually quite keen to be able to have some of their own funds, for instance, some kind of co-branded funds where they actually have some influence on the management strategy. And if they do have such a product, then they are in a position to put a lot more effort on promoting that particular product, because it's something that will give them the additional differentiation as a player in the wealth management industry. So there are quite a bit of demand in this particular area. And we feel that iFAST is well positioned to work with the partners in having such product that can become a lot more efficient than how things are done today. So that's one category. The other category perhaps to think about really is in the area of cash management products. I think in the area of cash management product, whether it's a money market type fund or something close to a money market, you actually find that there's still some gaps that are actually out there. And quite often the gap exists not because fund managers don't have expertise to invest in that. I think expertise in terms of investing in that asset class is there among some fund managers because we work with so many fund managers. But very often the bottleneck, the inefficiency, really is in the area of administration and settlement. How soon for how soon can the buying and redemption of the units of this cash management fund be settled? T+1, T+2, or T+0, or T+1 second. In China, they do it T+1 second. In Singapore, Hong Kong, typically I think in terms of T+2, some funds can do T+1, T+0. But if you think about it, no one in Singapore and Hong Kong are able to do what some of the Chinese players are able to do. Alibaba with the Europe, for instance, it's essentially T+1 second or something like that. So if we actually continue to do things the way it has been done historically, then you actually find that we're always limited by the inefficiency of the whole system. But a company like Alibaba or Ant, coming out of that year, they took the overall efficiency to the next level. And the reason why they're able to do that is because they control a few parts of the process. They control the distribution, they have a customer base, and they control the fund management settlement process. So when you can streamline all the different parts of the process, make the different parts interact a lot more seamlessly, then the efficiency can be brought to the next level. So this is one of those areas that we have in our mind. How do we bring the efficiency of a cash management funds to the next level? So we concluded that the only way for us to be able to do that properly is to have the ability to handle not just the platform powered business, but to have the ability to directly handle the fund management settlement process as well. So that is another area of the thinking that we have. So these are perhaps the two probably I hope you're able to understand the possibility that we're seeing.
The next question is from Victor. He's asking, he's saying that interactive broker recently eliminates monthly account inactivity fees. What's the management view on this?
Monthly account inactivity fee. I think we don't have any monthly account inactivity fee for this while, and we don't intend to introduce any. So I believe in this new world, you should not have a monthly account inactivity.
Next question from Rupan is, can you please give us some ideas of the timeline associated with the Malaysia digital banking license? By when do you expect to know the outcome?
Bank Negara Malaysia has stated that they expect to announce the winners of the Malaysian digital license in the first quarter of 2022. So first quarter next. So that's where we're.
Question from Robert. First half 2021 operation cash flow is 24 million less. 24 million less capex 5 million equals to 19 million. First half dividend is 66 million. Balance sheet net cash 61 million. Why not pay higher dividend? What's the cash flow constraint we are not seeing?
I would say that we're not seeing the cash flow constraint. The main reason why we are not paying more at this point in time is because we feel that as a financial institution group that has been growing and that expect to continue to grow and have a much bigger ambition, we feel that our present balance sheet size is actually somewhat small compared to many of the big financial institutions. So it is really with the thinking that as we move forward, we want to be able to further strengthen our overall balance sheet. So while we're increasing the dividend payout for this year, and we think we can continue to do so going to next year and beyond, we also want to take into account the size of our overall balance sheet as well. We also expect that as a group, we will continue to be applying for some additional licenses in different markets, different countries as we go on. When we do so, we will generally need to actually have some additional capital for that particular subsidiary that we start. And that's why, as a group, it's important that we have some balance sheet to allow us to work on those opportunities. So it's really with the intention of being able to do more of these things. Besides that, no major constraint.
Our last question for today is from Lopan. To achieve the 100 billion AUA by 2028, we are talking about 26% compound growth from the present levels over this decade. Do you see this happening from the existing organic growth from the current market/product, or is there any inorganic growth or new market products penetration built in the expectation?
We think that based on the 5 markets that we're already in, the potential is there also achieve the 100 billion just based on this 5 markets. We think that at some point in the next 7 years, there's a good likelihood that we will enter a new market, but we have not built that into consideration. Just based on the current market that we're in, we feel that 26% growth per year seems something that is achievable if you execute well.
There's another question from Yong Hong. Based on your existing license across your key markets, is there any additional products you could launch but have not done so?
I suppose, based on that question on its own, I'll say perhaps there are some products that we can launch but have not. It could be in different areas, or it could be work in progress, for instance. Or it could be that those products may not be products that we believe in. So there can be various reasons. We think that based on the existing license, the core product that we believe to be important, that's to a large extent there'll be some addition as we go on. Some are work in progress, and then some category where we believe to be more gambling products and so on, we're not looking. We can look at this.
These are the questions that we have today.
Okay, I think those are all the additional questions. I note that it's almost 12. So with that, we'll like to end the session today. Thank you, everybody, for dialing in for your questions. Thank you.